2025 has been a rough year for stocks this year, and I have three stocks I believe are great buys today in April 2025. And I have strong preference and reason to believe these three stocks will outperform the market in the next 5 years. And full disclosure, I do own all three of these stocks I will be talking in this video. And we're going to go over why I think they're going to outperform and what metrics I look for and if it'll be a good investment for you if you're someone young like me, because young investors do make a lot of mistakes and I'm learning along the way. But let's just go ahead and jump right to it. For each one of the stocks I'll be going over, I want to describe the return of the stocks for 5 years because as long-term investors, someone who's 20, I think ideal time frame you should go out to is about 5 years on the expected returns. So we'll be projecting the expected return of these three companies and why I think that is. And I think good buys of companies is around, if you think they're going to return around 15% a year, which gives you a hedge with the S&P 500, which returns about 10% a year. You don't want to be buying companies you think will only perform 10% year over year when you just put that money in an index fund, because 20% of my portfolio is in the S&P 500 index fund. And I do invest in individual stocks, but every individual stock I invest in, I make sure I believe will turn at least 15%. That way, on the downside, if it does perform the way I think it's going to go, then the S&P 500 is to be right on line with that. Rather than if I think if a stock's going to be 10% or 5%, probably like a company like Coca-Cola that's a slow grower, you're better off, in my opinion, just putting that money in a index fund, especially for someone young, rather than investing in the individual company. Now, to project these three companies I'll be going over in this video, you really only need to know two things. You need to know the earnings per share growth rate of the stock, and then the next thing you need to know is the price to earnings ratio of the stock in the end of year 5. And those two things really aren't that complicated. Earnings per share is just the net income of the stock divided by the shares outstanding. And there's analysis and expectations of each company. We'll be going over that. And the ending PE ratio, which is the price to earnings of the stock, we'll just be looking at the historical valuation of the stock and justifying a terminal price to earnings at the end. Because most companies trade near a PE ratio over the long run, especially if they're a well-known established company like the stocks I'm invested in. They usually trade at a PE of usually around a similar value. For each stock too, I'll also be talking about if the stock usually underperforms or overperforms when they report their earnings. Because say Wall Street expects the stock to grow its earnings per share 15% year over year. Well, does the company usually outperform historically, or do they usually underperform? Because usually stocks have trends, these companies have trends when it comes to that. So we'll be looking at the history of their earnings too and see if it's justifiable based on the calculations I'll provide in this video. And I'll also be using Qualtrim in this video, which is a tool that another YouTuber named Joseph Carlson invented. He created it, so I give him credit for the tool I'll be using. It just helps visualize these companies more, and I think it's a really good tool to use for YouTube. So the first stock I think is a great buy today in 2025 is Google, and right now they're trading at about 154, which is extremely cheap for this company because that's only a 19 price earnings ratio, and for a company that has a market cap of $1.9 trillion, a PE of 19 is pretty crazy because the other Mag 7 stocks, they trade at a lot higher valuation. And the main reason for this is for two reasons. For one, investors are scared that Google might sell off Chrome, but Google Chrome and the threat of it selling off has been really debated for the last 2 years, and it's really gone nowhere from the DOJ. And you have to think of Google's other assets, right? They have Google Search, YouTube, and YouTube in itself could be a massive business just by itself. Google Ads, $36 billion of revenue per year. And you have their network, you have the subscription business, which they're going to scale that with their AI. You already see the Gemini 2.5, and they're definitely competing in that, and it's definitely a good bet for that. You also have Google Cloud, which used to not even be profitable for them, but they're increasing their operating margins on that year over year, which you can see in that chart. And it just means that they have operating leverage, which over time more is going to drop to their bottom line, aka their earnings per share, and it's going to increase their earnings per share year over year, and it's going to cause the stock to rise at a faster rate than usual. So before I estimate what I think the stock can do in the next 5 years, I want to go over the best case scenario and the worst case scenario for Google. And more importantly, just the important factors to watch out for in the future of this company. Because in my portfolio, Google does make up about 12% of it, which is a higher position. I am bullish on this company. So the best case for Google is for them to just defend their search dominance, right? And really, they are. Even though there's a scare of LLMs taking search away from them, they're still growing their search business and their revenue about 13% year over year just in that department. So I don't see that as a huge concern. And if they can just defend that and keep that up, they're going to be in good shape. And for the next 5 years, I definitely see them doing that. The next thing is AI investments, right? Google does not get enough credit when it comes to their AI investments. You see it with Gemini 2.5. Everybody talks about Gronk and ChatGPT, but in my opinion, Gemini is just as impressive. And what really makes Google stand out in this is they can integrate their Gemini service into Google Docs. They can integrate it into YouTube. They can integrate it into the Gmail. Just a bunch of these services people are already using. And it's going to entice people to switch their pro plans that they use advanced AI to Gemini, in my opinion, just simply because of the ecosystem. Similar to how Apple has an ecosystem, I believe Google has a similar ecosystem where it becomes unmatched and it's going to be a key driver in growth for them in the future. Another thing with Google is their new self-driving Waymo technology, which is a self-driving car. And in the future, if you believe robotaxis will be a thing, then Google's going to be in the forefront for that because they're researching and pouring a lot of money into that. And they're already partnering with Uber, which is going to be a company I talk about later. And if they can just expand on Waymo, then they're going to increase their earnings more. And it's just another business. These huge businesses, they take all the profits they make from their other huge businesses and they pour it into other stuff. So it's just, that's why these huge businesses don't go away and why there's great investments to have in your portfolio, in my opinion. I think the worst case for Google is really just the DOJ breaking up Google Chrome, because Google Chrome does make up a huge portion of Google's revenue. And if that were to happen, I'd definitely have to consider looking at the stock and seeing if I wanted to sell it. Now, the stock is beaten up pretty good already in 2025. In fact, it's down almost 20%. And I think it's because institutional investors are more worried about this Chrome sell-off than they are the LLMs. I don't think the LLMs are a huge threat to Google search. I believe the biggest threat is this Google Chrome sell-off. And if Google Chrome were to sell off, Google stock would obviously continue to go down. But their price to earnings ratio is already so cheap. I just don't view it going down like so much. Like if this much drama were to happen to Apple, which trades at a higher valuation, then Apple could tank. But Google already has tanked. This threat is already priced into the stock, is essentially what I'm saying. Now, if we calculate the next 5 years for Google, which I have right here, analysis believe that they're going to grow their earnings per share by 15% year over year. 15 to 20% is what they project. So on this calculation, I did the lower end of 15. And then the terminal PE ratio for the company I'm using is 20. And right now they trade at 19. So 20 is a little bit more expensive. But just think about Google's business. The more expensive a stock trades, usually it's because it's a premium business. So 20 is really not premium. So it's more on the conservative side of that. So if you believe this scenario, and then 5 years, year over year returns, you're going to get 15% year over year, which is insanely good. In the worst case scenario, say they have trouble with Chrome or their search dominance does erode, which I don't believe is going to be the case, and say you decrease their earnings per share by 12%, and say their appropriate earnings per share multiple at the end of that, say we drop it all the way down to 16, and the lower the number, the less returns you're going to get because it's just not as expensive stock. People are not pricing it in as high as they should be. But even with 12% earnings per share growth rate, which I which is the rock bottom for Google for the next 5 years, and an ending ratio of 16, you're still getting almost 8% returns. So what I'm saying is, even in the worst case scenario for this company, you're still going to get 8% returns, which will still be in line with the S&P 500, which is why in my portfolio I'm investing in Google. I believe Google is going to outperform the S&P 500, and in the worst case scenario, it's going to match the S&P 500. And that's why I invest in individual companies. And I believe this in all the individual companies I invest in when I buy into them. And these next two companies I'll be talking about, it's the same story. Now, some people are scared of Google with their capex spending, which does take a free cash flow of the business, which does hurt investors when it comes to the returns, because they're going to spend $75 billion on capex when it comes to AI. But I don't see this as a threat. Google is simply just investing for the future. They're going to want to get return on that equity that they put into the business in the future. And I think it's a smart move to do to invest in new technology, because you see this in other companies too, like Amazon. And in the long run, as long-term investors, this will pay off. And one metric you can look at to see how efficient Google is just the return on equity. And you can see since 2022, they've increased their return on equity from 5% all the way up to almost 10%. So I don't see a concern when it comes to Google investing heavily into capex, because even their balance sheet proves they can do it. They have $95 billion in cash, even after the capex. So they need to put that money somewhere, right? And they can either pay a dividend, but they want more growth. So they're going to invest more in capex, which makes sense to me. And they could buy back shares, they're doing that already. But again, this company still makes so much. $75 billion is a lot, but the ideal scenario for Google is they're going to get return on that. And right now, the sentiment on Google is people are afraid they're not going to get return on that. But I believe they are going to get a return, because the company has done it for the last 5 years of the billions of dollars they've poured into investments. And I think it's a good scenario for Google. The next company I want to talk about that I think is a great buy today is Uber. Uber's in my portfolio today, one of my smaller positions. It only makes up just over 3%, but I really want to buy more of this company, because this company, it didn't even used to be profitable. In fact, they were burning cash. You can see that in this chart right here. Before 2021, their free cash flow was in the negative billions. But ever since management got out of the stupid stuff they were in, and they really started focusing on their capital light business, and that's why I like Uber. They're very capital light, right? They don't pay for the cars. The people who kind of contract with Uber, they're the ones paying for the car. Uber doesn't have to pay any heavy expenses. They're just connecting. They're almost like a MasterCard. They just connect the driver and their profits to the customer. And Uber takes a small fee of that. And this business is massive. They make up 76% of the market share compared to Lyft in the United States when it comes to ride sharing. And don't even get me started with their freight business and their Uber Eats business, because that's separate assets they have too for this. And this company is growing a lot. And you can see their free cash flow on average has grown 300% year over year since 2023. So earnings per share growth the next 5 years, they're expecting a lot. The company too recently issued share buybacks. And when a company buys back their shares, it makes it so that their earnings per share, which is one of the metrics I use for the next 5 years, like I did for Google, it makes it so that their earnings per share is going to go up even more over time. And they just initiated a $7 billion buyback program, which is a good sign for Uber, because they didn't used to do that. You can see in their chart, they've actually been increasing their shares, but now it's finally going to go down. And like I said, this company is very capital light. They barely spend anything on capex, unlike other car companies, right? It's really not the same thing, because they don't have any expenses when it comes to that. So the key driver to Uber is just their monthly platform active users on the Uber app. And that includes the freight, the Uber Eats, the ride sharing. They have 171 million active users. And if you believe robotaxis like Tesla or Waymo is the future, they're going to need a platform to where they can actually get people to do that. So Uber's going to have to partner with the car companies. And again, very capital light business. They don't have to actually pay for the technology. They're just connecting people. And Uber has that connection to where they can do that in this business, and that's how they're going to scale in the future. So I think the best case scenario for Uber is they become a dominant platform for delivery and ride sharing, and they're going to partner with Waymo. They already did partner with Waymo in these cities. They're going to go to Washington, D.C. That was just recent news. And I think this company is going to continue to utilize that. Now, projecting the next 5 years for Uber, Wall Street believes Uber will grow their earnings per share the next 5 years by 20%. And I have it at 18%, just be conservative. I have the appropriate ending PE of 16, which is very cheap. This company could easily be a premium valuation in the 5 years, especially if robotaxis become more of a thing and more of an idea in these cities, because it's going to be the company to actually do that in the long haul. So 16 is very conservative, and 18% earnings per share is very conservative. And with that, for the next 5 years, year over year, you're going to get 18% returns. So I believe in this very conservative case, you're still going to get 18% year over year returns, which is why I'm buying this company right now. I think the worst case for Uber is if Waymo, Tesla, and these other companies decide not to partner with them. But I really don't see a world where that doesn't happen, because Google and Tesla, they don't have an online platform like the Uber One app, where Uber does have. And if you think about robotaxis and ride sharing, there's going to need to be an app. There's going to be needing partnerships. So even in the worst case scenario, they're still going to grow. And even if you think Uber is going to grow at a smaller rate and their PE is going to drop, you're still getting positive returns. You can drop this to about 9% earnings per share growth, which would be pretty pathetic for a company like Uber, especially for a company that's turning it around. And a 15 inning PE, you're still going to probably match the S&P 500. So I think this is a very safe long-term play that I'm personally invested in. When it comes to Uber, it's no longer if they're going to make money, it's really how much money they're going to make. Because another thing they have going for them is on the Uber One app, they have advertisements there, and they're on track to growing their ad business to $1 billion in revenue year over year, which is something that doesn't get talked about enough in Uber. And that's a very low cost business too. So I love the business. They're heading in the right direction. They're in international growth too, and they continue to grow. And that's why I think it's a great buy today. Moving on, I think the best business you can buy today is Amazon. And Amazon makes up 14% of my portfolio. And its stock has gotten beaten up in 2025 because of consumer sentiment. But Amazon just has such a massive moat. It's insane. As you know, Amazon has all these businesses, right? They have their first party sales, they have the third party sellers, which are other people selling on Amazon. Their advertising business, which is only behind Meta and Google now, is growing and actually catching up to Meta and Google. That's going to be a huge business in the future. They have AWS, which is ahead of Microsoft Azure and Google Cloud, and their operating margin has increased since 2023. Just so many businesses for this company. Each one, Amazon has like 6 or 7 different businesses, and each one could be a massive business on its own. So it's just pretty sane to just see the investments Amazon's making. And that's the biggest concern with Amazon is their $100 billion in CapEx. But similar to Google, if they can get a return on that, and you can see the return on equity has just gone up since 2023. If they get a return on the capital they employ, this company is going to be massive in the future, and it's extremely undervalued today. In fact, Wall Street expects 20% earnings per share growth for the next 5 years, and I'm going to project it out to be about 15%. And if you look at the historic PE ratio of this company, you can see it usually trades at a premium valuation because it's Amazon, so premium companies are going to trade at premium valuations. But it's dropped all the way down to a 35 PE. So we're going to see what it'll look like in 5 years from now if it still trades at 35, which is cheap for Amazon. Keep that in mind, it's cheap. And if they can only grow 15%, which would be kind of disappointing for Amazon. And you can see you're still going to get 15% year-over-year returns for this company. Right now they're trading at 190, and I think this is rock bottom for Amazon. 15% earnings per share growth and ending multiple of 35. You're still going to get 15% year-over-year returns for this company. And say like best case scenario where they grow 20% and they have a 40 PE, you're going to get 23% year-over-year returns. This is best case scenario for Amazon. AWS continues to grow. They get above 25% operating margins, which they're well on their way there, and they get a good return on their capex when it comes to Amazon and them using Anthropic, which is cloud, which is the LLM that Amazon's investing heavily in. I believe this company is going to give positive returns the next 5 years. The question is just positive. So unlike other companies, the problem with Amazon is they don't do two things that investors love, and that's A, they don't pay a dividend. But if you're someone young like me, don't even worry about that because chances are when 30 years from now, the company will eventually start paying a dividend. And B, they don't really buy back their shares. But that's just because Amazon's using all the billions of dollars they generate year over year, like they did Q4, $100 billion. They're using that money to get even larger and invest in the future. It's just what Amazon did. It's what they did in 2022, and it paid off then. So I don't see why it can't pay off again today. Amazon is so much more massive than people realize. They have 400 million square feet fulfillment network centers, which is insane. Another fact about them I have right here is their stock split 21 in 2022, and if they didn't do that stock split, stock would be thousands and thousands of dollars just from 3 years ago. So I think it's buy today. It's my number one. And I think Google, Uber, Amazon, worst case scenarios for these companies, you're still going to get a positive return the next 5 years. They look attractive. They all have great fundamentals in their charts. And overall, I think they're great businesses. And if you found value in this video, as I'm a new content creator, please like, subscribe, comment, because it helps the YouTube algorithm push these videos out, which if they do well, it motivates me to do more of these. If they don't do well, then I don't know how much longer I'm going to be doing this, but I'm always going to personally invest my money in companies because we're living in an age where it's becoming easier to research companies and understand them. And it's pretty fun researching. So if you found value, just do those things. It'll help out a lot. And that's going to be it for this one. And I'll see you in the next one.